Jeffrey Rosenberg of BlackRock knows we've seen a standard deviation move. He is with their systematic multi-strategy fund. Oh, I can see you in the classroom as a freshman at Carnegie Mellon, Jeff Rosenberg, going, what in God's name is standard deviation? Did we get a jump condition today, Jeff Rosenberg, towards a less restrictive Fed?
Well, as Lisa pointed out earlier, there's a lot of data coming out today, and so parsing out the reaction from the Fed versus the earlier, kind of main event behind the Treasury refunding is a little bit tricky. But I would highlight that the main kind of differentiation is really the reaction in the front end of the curve, right? From the refunding announcement, that was really the back end, as Lisa highlighted, a little bit of the weaker data on PMIs also helping the back end rally. But the Fed market reaction was really in the front end. So I think Powell, you want to look at the statement and you want to look at the opening to the press conference. That's what they intended to say versus what the market interpreted from the Q&A. What they intended to say was to try to be balanced. Resiliency on economic growth implies we need to stay tight, maybe do one more against the tightening of financial conditions, which implies maybe we've done enough. That's what they were hoping to say. Clearly what the market saw was a preference for the worry of tightening financial conditions. We're at sufficiently restrictive, we can be done, and so you price out the little bit of probability for the next hike. That's the market reaction. As you went over in the earlier segment with Dudley, it remains to be seen. The data will dictate that. But certainly, to your question, Tom, big reaction. I think a lot more of that standard deviation move has to do with refunding earlier, a little bit coming out of this press conference.
Well, how do you play this then, Jeff? If you think that the market is reading way too much into what Jay Powell said, which was trying to stick close to the script, although perhaps giving a different tone than people thought of, do you then sell to your notes and wait for them for yields to go back up, for them to cheapen and buy them back?
Well, I think it's less a question about selling the 2-year note now. I think given the pricing and given the data that we have that Powell referred to, 2 more inflation prints, 2 more labor prints, and what Dudley was just hinting at, are we really seeing the degree of tightness, the degree of sufficiently restrictive, given the trajectory of growth that we just came off of? Obviously, no one expects that to persist, but the risk there is that you're not pricing enough of the possibility of another hike, and so maybe you hold off on adding twos from at these levels.
Jeff, from where you sit at BlackRock, and I understand there's an index play here, but there's some active management, and you're watching everybody else in the game. What's the bet of the market right now? Is the bet that we're going to get this Fed done in a more dovish, less restrictive tone, or is the bet, hey, we're scared stiff and we may move higher?
Well, I mean, you have a couple of different cross currents on there. Obviously, there's been a lot of talk about movement into the long end, movement of retail flows, buying the long end. That's very much kind of we're at or close to the end, and we're going back to the old playbook that once the Fed is done tightening, then you get a big rally. I think you got to be a little bit cautious about we're just simply going back to the old playbook, but certainly there's a degree of that in the market. And then the other really big kind of consensus story is around the steepness of the curve, that the curve is just way too inverted, that you need to see normalization of the curve, all the factors around that. The refunding was a little bit of that kicked in post the August refunding announcement. Japan and the news on the BOJ and yield curve control, deficit financing. There's a litany of lists, but there's a very popular positioning around the steepening. And I think the reaction to the refunding earlier today really reflects that very crowded steepening position that exacerbates that standard deviation move that we saw earlier today.
Jeff, I want to go full circle to where Lisa and I were early this morning. Folks, we've been live since 2 a.m. this morning. It's really, quite something. And Jeff, it's about the commercial banking system of America, which the chairman alluded to maybe a little bit and maybe not enough for my taste. Can we get a bond market that heals to take those bond losses and drift them away into 2025, where things can even get better if we don't get a massive bond move, but just enough of a bond move? Is that really the strategy here?
No, and you did hear that question. It was probably one of the few questions on that topic. I mean, this is a historic move in terms of interest rates. So, even if you get a modest kind of cut in interest rates that the bond market in the second half of 2024 is anticipating, that's nowhere near enough to kind of unwind the unrealized losses that you're talking about from this historic move from 0 to 5. So that's really about a long-term story of repairing capital and dealing with those issues within the banking system, that if you kind of repair the funding concerns, and that was what the bank term funding question was referring to, then maybe that doesn't become a crisis moment, but it still becomes kind of a longer-term drag in terms of capital repair, that even a small rally as is anticipated in the bond market pricing for 2024 isn't going to be sufficient to repair.
Jeff, you talked about positioning, and I want to go there because a lot of people are saying short squeeze. This is a positioning squeeze, and we've been hearing that a lot.
Yes.
How much is levered funds that have come into the Treasury market, how much is that what's underpinning some of the incredible volatility that we've seen over recent weeks?
Well, that's a tough one to sort of pin it on leverage. There's a lot of drivers to that volatility and to that uncertainty. Positioning and crowded positioning exacerbates those moves, and that can be levered, it can be unlevered, it can be just asset managers who favor particular positions.
I don't mean to interrupt,
Sorry,
Jeff, but there's a difference between real money investors who are making a long-term bet on treasuries and people who are fast positioning, trying to make a trade. Or is the market right now being determined by the trading types, not by the real money?
I mean, in short-term reactions, absolutely, right? Leverage is going to exacerbate reactions to price movements. So I think it's really about, decoupling, and you said it earlier, the near-term reaction isn't always to any data point, whether we're talking about the press conference or on Friday to payroll or CPI. That near-term move, yes, that's going to be dictated by algos. It's going to be dictated soon by AI. It's going to be dictated by the levered positions and crowded positioning. But let's separate that from kind of the longer run impact of the fundamental signaling. And as you mentioned earlier, you can have the near-term reaction, and then a day later or 2 days later, it's a very different trend as we parse the totality of the data. But certainly, very short-term price reactions are going to be driven by those levered factors.
Jeff Rosenberg, thank you so much, as always, for your comments on this incredibly important day.